So for the Series A investments in early stage deals, I would encourage entrepreneurs to try to get as clean a term sheet as possible. Because whatever unusual terms that they have in that first round are going to live on in subsequent rounds. So it's imperative for them to negotiate more on price than it is to bring in unusual terms that may hamper their future fundraising. In follow-on rounds, what we're seeing is more of what they call pay-to-play, which means that any of the preferred investors are required to do their pro rata amount of subsequent rounds, or they get converted in an unfavorable ratio to common shares. That is often a surprise to early-stage entrepreneurs who either put their own money in the deal or they bring in angels who don't recognize that they're going to need to make additional investments in subsequent rounds to maintain their preferred shares. It can be a real surprise to the entrepreneur and an even bigger surprise to their Aunt Martha. So the kinds of terms that entrepreneurs ought to expect are more syndicate partners coming into early stage deals. We typically do 2 to 3-handed deals even in our Series A. And we'll often bring in corporate investors as early as Series A. The objective there is to make sure that you have enough money around the table to keep the companies financed. We try to do very clean term sheets. Our focus is to make sure that we're not inserting anything into the early terms that are going to live on in subsequent rounds or to deter future investors from coming in. We're also seeing more tranching of deals, and that's not necessarily a bad thing. VCs want to be in a position where the milestones are achieved before additional money comes in, and if the company is achieving their milestones, then that triggers the next tranche. But it provides the entrepreneur the security of knowing that they have the company financed all the way through to a major milestone, and ideally that would be the sale of the company. I would encourage the entrepreneur to be focused on what is really important to him or her. Is it your role in the company? Is it getting the highest valuation? Is it getting the company financed to an important milestone? Is it having a clean term sheet? And I would focus on raising the money with a clean term sheet so that you're in a position to achieve important milestones that will allow the company to be financed down the road. I think if the entrepreneur is reasonable in their approach, the VCs will tend to be reasonable back, and it'll make for a much better environment as the company comes together. Remember, once the deal is done, the VC is part of your board, and it really sets the tone for how you interact going forward. I think if the entrepreneur approaches this with the mindset of being reasonable, that will be reciprocated, but the market is going to set the price and the deal terms. And the best way that the entrepreneur can be in a strong negotiating position is to have multiple term sheets. And that starts with getting a number of interested players, and often those players will all come together in a syndicate that can help finance the company all the way through to success.